Da 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 da. We don't have music yet for the intro, so welcome to Big TV. This is our first real interactive show with Phil or Kill. We are bringing on our first guest that's pre-planned and that's operational, and we have, as always, Ed Matz, the infamous trader from from London. Good morning, Ed.
Infamous, notorious, controversial, contentious, all round good guy. Yeah, yeah. You can
Infamous.
you can insult me no more.
How are you, Ed? You had a little bit of time off yesterday, right?
Yeah, no, I wanted to go and see a few people in London, and yeah, no, it's good.
Yeah, that's
It's good.
nice.
Some interesting. It was very diverse, diverse. Yeah. I stayed overlooking Buckingham Palace. It was
Oh,
kind of
really?
cool.
That's very posh.
So yeah, but it was good. Just it's good to get out there and meet a few people and put faces to names, etc.
Yeah.
And discuss some interesting ideas and things I'm doing, markets, not markets, all sorts of different things. So it was a good break. Yeah.
But do you
As
think that's good?
Jesse Livermore. There's my. Actually, I didn't have a Jesse Livermore quote for today, but now I can bring it in. Is that you cannot trade all the time. Emotionally, you're not strong enough. You need to
Yeah,
take a break, take a vacation,
yeah.
go fishing.
That is very true. And I think, don't you think that's a like big part of it? That sometimes you just gotta smell the roses to sort
Yeah.
of rebuild that inner whatever it is.
Definitely, and also get perspective.
Yeah,
It's funny. I think the more you think you do something, the more you become tunnel visioned. I mean, it's a
yeah,
really good phrase because you don't see the perspective, you lose the perspective. So it's good to step out. And obviously, from on a daily basis, it's good to step out. I like to go running, etc. And most of my best thoughts about anything when
yeah,
I'm running. So it's just good to take a break and actually think about what you do rather than just do it.
yeah.
So it's
I think that goes because since I run a startup here, I think that goes for me as well. I've started doing this morning routine instead of just working, trying to go to the gym in the mornings, and it really does change quite a bit. I mean, you completely fall apart as an entrepreneur. Like physically, it's very hard to keep track. And I talk to a lot of people that do startups, and it's such a like something you would never think about. And just when you get to that level where you can take some time, I think that's a big, really important.
but yeah, I mean, but disciplined about it.
Yeah,
Don't just say, "Oh, I can't take anymore. I'm going to take a week," and then you find that your startup is
yeah.
folded.
No,
You know,
that's very bad.
so yeah, it's all about
So, what do you want
balance.
to talk about today?
Yeah, what I wanted to do really was to kind of carry on a theme. We talked, I think, was it last week, talked about correlations and how markets are, the wide range of markets are related. Many markets are related to themselves or to each other or other similar markets for whatever reason. And it's putting those pieces together like a jigsaw. In fact, let's start again with Bruce Kavanagh quote about how market analysis is like a tremendous multi-dimensional chessboard. Have you got that quote to hand? Bruce Kavanagh, great trader, famously great trader, trading serious amounts for Caxton Associates, a big hedge fund. Um, but he uses a lot of different techniques and brings everything together, but looks at a different range of markets and is very aware, as many hedge funds are increasingly aware about the correlations between markets and how they react. And we talked about a whole show on correlations. But an area I intentionally kind of stayed away from was what's called intermarket relationships or intermarket analysis, where markets essentially there are four major markets, and if you've got a chart there of the four major markets, if you like, there's the interest rate markets, the bond market, the stock markets, the S&P, the CRB reflecting the commodity market, and in this instance, the dollar index representing the dollar and the currency markets. Those four blocks and how there is a relationship between the four.
Yeah,
And the question then becomes, okay, how do they react? And do they react together? Are they related? And
yeah.
are there causal links? Remember last time I highlighted what's his name, Nate of the
Nate Silver.
election thing.
Nate Silver.
Yeah, exactly. Nate Silver, he talked about, yeah, that's it. How correlation doesn't necessarily imply causation. So if you apply that, so I want to apply a few of the things we talked about last time on correlations, but to apply it to the interrelationship between the bond market, stock market, commodity markets, and the currency markets, and particularly the dollar. And that, they are correlated oftentimes, but it doesn't necessarily imply causation. But by the same token, the point I was very keen to make last time, and I think we need to be aware of, is it's very easy then just to say nothing makes sense. It's all pretty random. I'm just going to stick to one element, one thing, and splice it. And you can luck it. You can make money trading that way because you just got your edge is good enough. Or you can actually help yourself by recognizing they are related and that correlations can imply causation, that there is a causal link between those four markets, and increasingly so.
Yeah.
Some of the reasons, actually, if you want to put up the reasons for the correlations you talked about last time, do you want to read them out? Because I actually can't see that.
Yeah.
Yeah, okay, I can see
So,
that now. Causality, I've just talked about causality, but sometimes the causality is reinforced because people see a causality. For example, with bond market is falling, interest rates are going up, and the dollar is strengthening on the back of that. Well, there's a simple reason, not just because people are buying the dollar because there's a higher causal link that might reflect inflation and inflationary growth, which means dollar assets should appreciate, and therefore you buy dollars as well. But also people know that if the bond market goes down, the interest rates will go up, therefore the dollar should go up as well. And that's kind of reinforces the perception of causality is quite important. And then there's the correlation of whatever, let's say taking it back and making it slightly complicated, of the dollar via inflation. Inflation in the States will be correlated, in fact, inflation in the States may cause the bond market to go down and the dollar to go up at the same time. And it depends, a lot of it is how we classify them. And that's quite important actually, of those four blocks, you think the bond market, stock markets are pretty well defined.
Yeah.
And but less so the commodity market because of gold, particularly precious metals, and their relationship with inflation and the relationship their haven, safe haven status makes them slightly different. And the same for the currency markets. We tend to think of the dollar in terms of the intermarket relationships, but clearly, as with the growth of risk as a concept, euro yen, for example, has come closely associated with being a risk currency as opposed necessarily just to the dollar.
You have a nice overview of this, and I think that's probably of all the things you've shown on this show, it's my favorite. It's the way these correlations have changed, or the way the perception of risk has changed. Like you say with the yen, with the risk on, risk off thing you have here.
Which one? Just put it up.
Yeah, I just think this is really good.
Yeah, and how the US dollar from 2005 went from being a risk appetite currency, the risk associated with the stock market. Then obviously you had the credit crunch, Lehman, and everything else, and then suddenly it's at the bottom. It's interesting, and it begs the same recurring theme. It begs the same question as to why these things happen, and do you need to know why? And it then comes down to how you trade and what your edge is and how you found you make money. If you find you make money by not begging the question why, then don't beg the question why. If you find that by begging the question why, you often save yourself from a complete disaster, as my approach, then it helps to know why. I've explained many times what I call best fits analysis. Fits for F for fundamentals, I for intermarket relationships, what we're talking about today, T for technicals, and S for sentiment.
Yeah.
But it's about intermarket relationships that I want to talk about. And the grandfather, today we're really lucky actually, Ashraf Lady is about the best there is on this field, in my opinion. But the grandfather of intermarket relationships is a guy called John Murphy, who became increasingly evident, particularly around the 1987 crash, that markets were increasingly related. The globalization of markets, and particularly with events like that, seemed to cement it. It's funny that a similar thing happened, obviously, in 2008 with the crash. Again, correlation seemed to increase significantly. And in fact, there's a nice little clip about how he describes the importance of intermarket relationships. Can you play that?
Yes, I have it here lined up.
When he's sitting in a chair, looking a little older than in that nice profile picture.
Oh, do you want that one? Not the one with from 2011?
No, the one of
Okay.
him sitting in a chair,
Yep.
looking cozy.
Just cut to that. So I'm doing a little hack to make it work.
Why not?
1 second. There you go.
They know I've written several books on the subject of intermarket analysis, and I think it's really important that anyone who's involved in the markets, in any market, anywhere across the financial spectrum, understand just what intermarket analysis is and why it's so important. For almost a century, the approach to the various markets was very much a single market approach. For example, people who traded stocks just looked at stocks. People who traded commodities just looked at commodities. But if that's all you're doing, if all you're doing is looking at stocks by themselves or commodities by themselves, you're missing a tremendously valuable information. And in fact, stocks, commodities, currencies, and fixed income all interrelate to one another. What happens in one sector affects another. For example, rising commodities are normally a sign of economic growth, which is usually good for the stock market. At the same time, it's bad for treasury bond prices. So to ignore these interrelationships is really to deprive yourself of tremendously important information. What happens in one market tells you a lot about what's happening in another market. For example, when the U.S. dollar is falling, that's usually very bullish for commodities and stocks tied to commodities. So I think the old days of using a single market approach, it's really very obsolete. All of these global markets are linked, and I stress global, foreign markets as well as U.S. markets. What happens overseas has a tremendous influence in the U.S. markets as well. So I certainly encourage you, in addition to your normal technical analysis, to study these intermarket relationships. It adds a new dimension to technical analysis, and I think a very valuable dimension.
Yeah, that's well said. What I find interesting, there's two things I find really interesting about that. One is it's clearly quite the growth of intermarket relationships or analysis as he kind of kicked it off in 1987 seems very dated, and how we could ever consider that they weren't related.
Yeah.
But the world was far more isolated and smaller place than it is now in many respects. And the second thing is how he's talking about the need for technicians to look at intermarket analysis, because typically you would think it's an area of fundamental analysis, how markets relate and the causal links are fundamental, and therefore it's the economists who should be paying attention. But he's talking specifically from a technical analyst or technical trader's perspective. And I think that's really important, because in doing that, he's exploded the whole technical trading approach, which is why it's the same reasons why I've gone from being someone who specializes in Elliott wave or trend analysis, or you can be using RSIs on one market and doing well or badly on that, to suddenly becoming quite a different beast, quite a different trader, because you've recognized through your profit and loss streams that if you don't pay attention to the relationships, you can get it horribly wrong. And also that you can pick up on so many opportunities. This is the importance of an intermarket analysis for me, is that if you miss a market, because of the causal links between the four sectors, you can get on board in another market and make some serious amounts of money by following those links. And by the same token, you can protect your ass in case something goes wrong. What is interesting also is how it came back to the forefront in the 2008 crash, when the correlations went up, when everything seemed to be moving in sync again. And it was interesting to see that he did a actually it was I think it was a presentation. John Murphy did a presentation in 2011 on some of the relationships as they were then, having changed quite a bit since 1987, and now they changed again. So what I want to do is just show what John Murphy's talking about in 2011, and then if Ashraf's around, we can bring him, because Ashraf is very much, if John Murphy is the father of intermarket relationships, then Ashraf is very much the son, or
Let's go.
I was going to say bastard,
Oh,
because
well,
I don't think Ashraf, and rightly so, doesn't necessarily key off John Murphy, so he's kind of on his own. But any excuse to call Ashraf a bastard is fine. But
well,
anyway, so I mean, he's very, very good at this.
I
So
can just
what I
turn
wanted
on
to do
his
is
mic
take
if you
John
want.
Murphy is talking about 2011,
Yeah.
talk a bit, and then Ashraf's written a book about the subject as well,
Yeah.
and then bring Ashraf in and talk about how it is now. So could you
The
play
first
that
one
clip
is stocks and commodities move together. You can see that on a daily basis. Not gold necessarily. Gold is in a class by itself. We'll talk about that in a little bit. But on a daily basis, today, for example, the stock market's up, commodities are up. So we'll talk about that. Generally speaking, stocks, because they're both a barometer of economic strength or weakness. Take the oil market, for example. When the stock market's down and people are nervous about the economy, the price of oil tends to go down. They've been moving very, very much in lockstep. When the stock market rebounds, people become a little bit more optimistic. The price of oil, the price of copper tends to go up. So they're very closely linked. We'll talk a little bit more about that. Another one is that the stocks and the dollar move in opposite directions. Now, this is a fairly recent. Historically, this does not hold up. If we were to go back and look over the last 10, this is not a relationship that is really historically significant. In other words, if you go back, there's very little correlation between stocks and the dollar historically. However, over the last couple of years, for some reason, they have become inversely correlated. So that is the situation right now. So that's why we take that into consideration. So generally speaking, stocks and the dollar. So you'll notice on most days, if the stock market is up, the dollar tends to be down. They move in opposite. The dollar has become sort of a safe haven to an extent. Okay, here's another one. This is probably the most constant of all of the intermarket relationships. Commodities and the dollar move in opposite directions. I've shown many charts on our site, and I don't have time to go through all of them now, but if you were to look at any chart in history, you'll see that, for example, the commodity boom over the last 10 years. The commodities have been the strongest asset class over the last 10 years. It started in roughly 2002 when the dollar went into a major decline. So we can show you all kinds of charts to that effect. Maybe not happen every single day, but generally speaking, when the dollar is up, commodities are down, and vice versa. Stocks and bonds move in opposite directions. We've already talked about that, and over the last month, money coming out of stocks has poured into the bond market. If you're pessimistic on the economy or economic growth, generally you favor bonds. And if you are optimistic, generally you favor stocks. That's generally, but there are all kinds of ripple effects that flow from that. Commodities and bonds move in opposite directions. Generally speaking, rising commodity prices are inflationary. That's normally bad for bonds. So it also makes sense if commodities and stocks move in the same direction, both move in the opposite direction of bonds. And this last one's kind of a weak one. We just threw it in there. Bonds and the dollar move together. That's actually a very loose correlation between the two. If you look at bonds have surged, the dollar has just bounced a little bit. So it's kind of a weak, but generally speaking, you'll notice that on most days recently, if the bond market is up, the dollar is up. Today, I'm just guessing, I think the stock market's up today. My guess is bonds are down and the dollar's probably down. That's my guess on that. So those are the intermarket.
It's a lot of stuff that's changed since then, or?
Yeah, pretty much. It's things tend to ebb and flow, but I think it's a good opportunity. What I was curious there is how a lot of time for John Murphy, very clever guy, and he's kind of encouraged this whole area. But how anyone of his ilk would say, "I don't know where the market is today," is kind of, I find strange, because I can't not know where the market is. It's just the nature of the beast. But anyway, yeah, well, it's an ideal opportunity to bring Ashraf in if he's around.
Yeah, I have
Yep.
turned on his mic. Are you there, Ashraf?
I am on. Hello.
Hello. Good.
That's
Good
Hi,
so
night.
guys.
fine.
Hi, Ed. Hi, Zvera. Zvir or Zvera?
Either way.
Either way. Okay.
Call him severe. Most people do.
Severe. Yes. And it's a very severe subject that we have to tread very carefully here. You got to stay away from making all encompassing statements and all absolutist statements and saying this always moves along with that forever. You got to be careful. When you don't know, you have to say you don't know. When you say you're not sure, don't be shy in saying you're not sure.
I
And that's
couldn't
what we're
agree
gonna
more,
talk
which is
about.
why I wanted to bring you in, because even from 2011, you know, some of the statements John Murphy was saying of things have clearly changed. But before we jump into those people who don't know you, I should give just a little brief introduction. I've known Ashraf for seems like even longer than 3 years, but it gives me the license, I think, to describe him as the son or one of the experts, or probably the expert in intermarket analysis when it comes certainly to currency markets. Ashraf has been has set up his own operation. What's the URL for that?
Yes, it's ashraflaidi.com, and I'm also doing stuff with cityindex.co.uk, which I will show the URLs for both in a minute.
And more famously, was it three years ago you wrote a book on intermarket analysis?
Yes, indeed. Yes, and
it's
here
very,
it's
it's got
and
it's very. Can
this
you
is
put up yeah,
yeah.
exactly. In fact, that plugs City Index as well at the same time. I don't know if you see that.
Yeah. So
In fact,
basically,
Ashraf, I've
yeah.
got talking since I played John Murphy. There's a little video I want to show you, really interesting, about a guy who was talking about your book 3 or 4 years ago. Can we play that, Sverre? Have you got that?
Taleb Mandelbrot?
No, the
other one.
the
Yes.
Ashraf book interview.
Yes, I do.
See if you remember this this interview.
3, 2, 1.
We need to catch the tune like this.
Actually, we were doing the advantages and the disadvantages of floating and fixed exchange rate. This is back when I was 17 years old, and I took economics in my high school in the IB, the International Baccalaureate. And from then on, and then I said, do I want to be an economist in school? So as a bachelor's, I took business. But then when I went to my master's, I started getting the idea to this thing, Jeff, that is not very well known, and it's called central banking. You know, the Plaza Accord, the Louvre Accord, central bank interventions. Do they work? Who are these people who are closely veiled and closely guarded? And then you know, because they impact the price of money, and that is interest rates. So flashing forward or fast forwarding to 2001 and 2002, you know, when the dollar reached its 17-year highs in February 2002, when the dollar started going officially into its bear market, when commodities started to push higher, or gold and oil, you start seeing these relationships. At the end of the day, and here's what I want people to know, one of the things that I want them to know, currency markets, there's many players in the field. Right. And what you want to know, you want to buy always the weakest player. I mean, buy the strongest player versus the weakest player. You have the Aussie, you have the Canadian, you have the New Zealand. Yes, they are commodity currencies. You have the lower yielding currencies, you have the dollar, you have the yen, and you have those in between. And sometimes the clue is not always in the currency itself. Sometimes you get the clue from the stock market. Sometimes you get it in the relationship between gold and oil. Sometimes you get it in the yield curves. And that's what my book, Currency Trading and Intermarket Analysis, that's why it is really, I wouldn't say the first, it's the second book after John Murphy's Intermarket Analysis. It's really the second book that really delves deep into this, but from the idea of currency markets and how you can make money in it by looking at the yield curves, looking at the steepness of the yield curves, looking at valuing gold in different currencies, and looking at equity indices. And, you know, I think this is a very long answer, but I'm sure hopefully you're going to do some editing.
Yeah, that sounds...
that's really good.
Ashraf, sorry to spring that on you. I just thought it was such a lovely interview and might be nostalgic for you.
Yes, no, it's good. Thanks. That actually makes me do less work this morning. But I think for those of you who did not get the quality, the audio quality of that, basically what I'm not going to repeat what was said in the interview, but the big difference about between John Murphy, I remember I picked it up in like in the mid '90s, and I was looking at it and I said this is very interesting, but I delved into many more details in my own book, which is basically I actually talked about the exceptions when gold moved in tandem with the US dollar. Okay, so before my book was written, people who had any idea about commodities, they would always say, well, you don't need to be a genius to know that commodities, when they go up, the US dollar goes down because commodities are usually priced in US dollars. But, chapter one, you didn't need to go very far. Chapter one in the book, it basically says, talks about 2005. And 2005 was the year when the dollar went up and gold went up. And we talk about that. And that's why I said you have to be careful in sticking and enslaving yourself to these relationships, because the positive correlation between the dollar and gold did revisit the market in big time in 2011 and 2012, and we saw it many times. But look, so I don't want to make this morning about, making statements and you taking the statements and taking them home with you and sleeping with them and then, making your trading according to that. So I'm going to try to be a bit flexible in this, and I'm going to try to say about the things that don't work anymore. So basically, yes, since 2006, 2007, there was the risk trade. So basically, and I'm going to demonstrate this in a chart. So basically, for a while, if you look at this chart here, so basically this is the euro dollar, and this is the S&P, and so for a while, basically here, let's just go here, and so in general, you could see, in 2006, 2007. When you had the S&P going up, you had the dollar going down, and then you had the euro going up. This is the euro versus the dollar. We're going to worry about this later on, about the bottom chart. But basically, just to summarize this, and what John Murphy said, he said it's a new phenomenon. When he talked about the new phenomenon that, that when dollar goes down, stocks usually go up. And
Ashraf, can I interrupt you? Can you just say to people what those the charts are of which lines are which, so that just in case they're confused.
All right. So I'll say it again. So basically, the white chart is that of the euro dollar, euro versus the dollar. So when this chart goes down, the euro is going down and the dollar is going up. When this white chart is going up, that means that, okay, so this is the white chart and its scale is on the right. Okay, so basically this is the euro in June 2006. This is the euro in April 2007. This is the highs in 2008, i.e. the lows in the dollar. Okay, and the chart, the blue chart, the green shaded chart, which is the blue graph, is the S&P. And obviously, you don't need to have a college degree to realize that these move in tandem. Okay, so let's try to explain the whys rather than just the what. Try to explain the whys, and rather than just stating the obvious. And the reason, okay, before I go into it, when the dollar goes, so this is the euro going up and stocks are going up. That means this is the dollar going down and the stocks are going up. The other currency that usually move inversely related with the stocks is the yen. So I will explain why the dollar in general, why the dollar moves in reverse to stocks, and that's in general. Why is that? This relationship started probably in 2005, 2006, when putting money outside the US became very common, when the Eurozone became a credible competitor as far as markets, as far as equities, when emerging markets in East Europe, Central Europe, Latin America. So when stocks went up around when stocks went up around the world, when stocks went up in the United States, there was risk appetite. Things usually went well, and portfolio managers in and outside of the US wanted to basically venture abroad. Okay, and when stocks were up, they people had the confidence to venture abroad and to take more yield, to seek more yield, because the market became overcrowded in the US in general. So there were more bargains in Latin America, in Eastern Europe, in Central Europe, in Southeast Asia, in East Asia, and so on and so forth. And therefore, when stocks in general went up, the premise started to follow in the following way, which is money came out of these portfolio managers and was deployed into other currencies, into non-dollar currencies. When stocks went down and when stocks around the world went down, what did these portfolio managers do? And that's what people have to pay attention here in about this point, is that when there was a storm out there, and when there was volatility out there, and when stocks were falling, whether it's 2000 February 2007, or the October 2008, or summer 2011, the money would go out of stocks and it would be put in cash. And cash, the safety of cash, was generally held in US
Ashraf,
Treasury
Yeah,
Ashraf, that's interesting because there's you're talking about the correlations or the interrelationships being moved by the weight of money, if I read you right, and that is separate to the cause. What we assume to be the typical textbook economic causal links. Do you think that's an import? How the money moves is more important than what the textbook says should be happening, or you think the money is moving on in line with the textbook, or it's a movable feast?
Yeah, definitely. You have to be able to understand what you, Ed, call the movement of money is basically this flow analysis, and basically it's an approach that many currency economists and currency strategists are increasingly concerned with, which is basically we care about money flows. We don't care about, if inflation in this country is doing this, that means we have to sell the currency of this country,
yeah.
because
Do you
that's
mean
what
like we saw in India last year when you saw the current account becoming a huge issue for the Indian rupee? These kinds of issues when you see external flows having such an impact.
Well, yes, that is one case, but I'll tell you another case, for instance. So if you want to talk about it from the way of current account, let's say the U.S. dollar, when it reached a peak, when it topped out in February 2002. Some people would say that the high was 2000. I would say 2002, because the difference between the peaks was negligible. But I want to say I want to use the 2002 in February, and then afterward anybody wanted to make money in the currency market would just put a blindfold and they would sell the dollar in 2002, 2003, 2004. Okay, and they would still make money. Why is that? There were two reasons. One was because the United States, the government, was engaging in a policy of benign neglect, basically talking down the dollar, but never mind about the, the verbal aspect. It's the macro aspect. And what happened? The U.S. had a widening budget deficit, a widening current account deficit, and at the same time, it had low rates. It had lower rates. So that gave 1,001 reasons why people were fleeing the dollar. And at the same time, the rest of the world was improving. But let's just take this conversation to more practical terms and less historical terms, okay? So let's just stick to what I was saying before, which is basically the money flow, which Ed asked about. The money flow is important. So there is basically the deployment of capital. When there is a storm and the sky is no longer blue and the birds are no longer singing and there is volatility up and the VIX is up and the stock market is down, okay, a lot of that money is being put into the safety of cash, and cash is usually in treasury bonds and treasury yields, and that's why usually bonds go up, i.e. yields go down, and the dollar is actually holding. And I want to say something else which is very important, and I want you to pay attention to this. When you played that video with John Murphy, he was very sure and very convincing when he was talking about gold and the dollar. But when he was talking about bonds and the dollar, his voice started to lighten down, lighten up, and his conviction was easing.
Yeah.
Why? Because there is no definite correlation between bonds and the dollar. And anyone that tries to tell you that there is a definite correlation between bonds and the dollar either does not know what he's talking about or he's laughing at you. And case in point, when I took my book and I started to write my book in April 2007, and I had to put in the table of contents, there was many things I talked about. I talked about the gold-oil relationship, which nobody has mentioned before. I talked about, the gold relative to oil and what it means. I talked about yields and everything. And I could have, and I wanted to talk about a chapter between interest rates and the dollar, or bonds and the dollar. But I chose not to. Why? Because because the correlation kept on changing.
Yeah.
The correlation kept on changing.
But
So
have you
either
seen
I had,
correlation changes lately? Because we've seen
okay,
like gold, for instance, changed quite a bit in 2011, the way
well,
it's traded, and now with the end of QE, you would
okay,
expect that,
yes.
there should be a sea change.
All right,
Actually, Ashraf, before you answer that, quantitative easing, to what extent has the flood of dollars, that money, because you talked about flows being arguably more important, to what extent has quantitative easing changed the relationship between markets?
Okay, so I was going to continue talking about bonds, and then Esver mentioned gold, and now Ed is talking about quantitative easing. So I'll try to unify all these three topics in this
Good.
in the next sentence. Okay, all right. So basically, just if you allow me, actually, a quantitative. I'll take the recent, the last question, which is quantitative easing. Basically, uh, let's talk about quantitative easing, and rather than using words, let's use the chart. And here's what happened, guys. So quantitative easing started in March 2009, at the same time when stocks reached their multi-generational lows. Okay, March 2009. That's when the S&P hit a 12 or 11-year low, and the FTSE hit so many lows and lows and lows and lows. And it was the month when both the Bank of England and the Federal Reserve started their asset purchase program. And that coincided with the S&P reaching the lows of that magic number 666. Yes, 666. Okay. So here you are. So March 2009. So here's what happened. So to answer the question, so what happened is that before we crashed, the high was in around 2008. There was inflation. The ECB was raising interest rates. The markets were pushing higher, and then basically when the market cried uncle, money started to come out of the stock market. Money started to come out of commodities. Money started to come out of what you call risk assets. Risk asset meaning it's an asset that usually goes up when people want to take risk, when they want to have a proclivity towards risk. That's why you call the risk asset. And then money started to go back towards, it's what you call the fetal position. Okay? When the market is in a fetal position, when it goes in and it curls up and it sits like this and it's afraid of what's going on, and the money goes into the US dollar. Okay? So for those of you who did not appreciate the visuals, it's okay. All right. So the market started to go towards the dollar. Commodities started to go down. And then Ed Ed, you asked me about quantitative easing. What is quantitative easing? Quantitative easing was initiated by the United States. Quantitative easing, you are putting money into the system. You are throwing money into the system. You are a central bank and you are basically buying bonds. If you took economics, when a central bank wants to buy bonds, when you buy something, you put money into the system. When there is more money in the system, the value of that thing called money goes down because there is more of it. And then that money is in dollars, the value of money goes down and interest rates go down, or the yields go down. So basically, and that's why gold started to push higher. And obviously, stocks would benefit from that called reflationary trade or stimulative trade or QE trade. So the blue one or the green is the stock market. The euro, okay, against the dollar is the white. And this is when they started. And then basically the QE1 started here. QE2 started then later in 2010. This is when you may you may be wondering what happened in December 2009. December 2009, that's when actually the market was expecting the end of QE1. And look, I mean, we can talk about history for forever, but this is the euro crisis. This is the eurozone crisis. So the euro went down. But here is what you have to pay attention. The stock market diverged, meaning the stock market was moving higher and the euro was moving lower. So that means that the dollar was going up, okay, and the stock market was going up because the approach was that the global growth is going to be led by the United States, and therefore the global growth was going to help stocks and mainly coming from the U.S. dollar. But this is a story that basically comes and goes, okay, and so but then here is what happened when and this is you had the eurozone crisis, but this relationship, it remains, and I say quote unquote, generally positive between stocks and between the dollar or between the Aussie or sorry between stocks and between the euro or the Aussie or so on and so forth, and but it sometimes changes, but the currency relationship that has a stronger correlation with stocks is not really the dollar, meaning a stronger negative correlation, but it's the Japanese yen. And the Japanese yen continues to have that. So basically, let me just show you this.
So you
I'm
think
gonna,
how it was Murphy traditionally described the fourth block, the currency block, as the dollar? You think that should be treated more as a currency block, and in fact the yen probably features more strongly as having a higher correlation to the other three markets? Is that
yeah,
your
I
point?
would say the Japanese yen has more of an inverse correlation with the stock market than the US dollar is now having. Okay? So before, in 2006, in 2007, in 2011, in 2012, when stocks would go up, the yen would go down, and the dollar would go down. This relationship, to a certain extent, it still remains between the dollar and the stock market, but it remains firmer, clearer with the yen and the stock market. And you don't have to take my word for it. Let's look at it. There is another relationship which is actually even stronger, which we need to mention. Okay, but before we move into it, let's just talk about the currencies and the stock market. So between the yen. And so basically, if we just include this, um, so usually I use the S&P as the stock market, or you can use the FTSE, or you can use anything. But basically, yeah. So
The reason I
okay,
asked that question because I mean some people will be new to the concept
right,
possibly, or
right,
the approach of using intermarket analysis, and rather than get your head around all the different stock markets out there, people do traditionally use the S&P as probably the greatest representative of the stock block. And certainly with the bond market, fashionably now it's the 10-year as opposed to the 30-year US market again. And now, whereas traditionally it seems to be quite, maybe because it was Murphy or more likely a reflection of the dollar being king, that people used the US markets as a representative of those four blocks, particularly since obviously the commodities are expressed in dollars. But of late, and this is an important point I wanted you to dwell on, and you did, thanks, was the yen. The yen has become far more representative of the currency bloc when it comes to its relationship with the other blocks, because it is truly the risk currency as opposed to the dollar. I just want to reinforce your point.
And I had a letter, and I argued in a letter in April of last year in the Financial Times, a letter arguing with Axel Merck. Axel Merck is a German or Austrian hedge fund manager who is very smart and very very gold bull, and has been very smart in actually being one of the few people who came out and said that the euro is going to be going up in 2013. Okay, and he was very right and many were very wrong. Anyway, Axel Merck basically wrote an article in the Financial Times in 2013, I believe it was March 2013, and he said that the Japanese yen was no longer going to be a safe haven. And oh, by the way, the reason that I'm speaking like this in a very slow tone is because this subject could be complex to a few people. So that's why I'm trying to speak in a very clear and slow manner. That's not how I usually speak. Okay, this is a footnote that I should have added earlier.
Yes, fine. Later, I was going to show a clip of is a video I found of Mandelbrot and Taleb. And Taleb was if you think you're being deliberate, he was incredibly deliberate. So I wouldn't worry. It's good that people understand, because it's an important concept.
There is a lot of information that is being said right now. There's a lot of information, and it's very new to a lot of people. And I realize that when you speak about something they usually speak about, you can speak about it very fast. But to people who are listening about who are listening to it for the first time, they may have some issue.
I can tell you something. We have people all over the world listening now. We just got word that we're on a big screen in Australia somewhere.
Okay, guys. So let's try to make this point. Okay, so basically, what Axel Merck was saying, he was saying that the Japanese yen was losing its safe haven status. His point was that because Prime Minister Abe in Japan was going to engage, finally convinced the Bank of Japan to double asset purchases, he basically said that the Japanese yen is going to go down and the stock markets around the world were going to go up, and so on and so forth. And I agree that, but his notion was only correct, meaning when stocks were actually up and the yen was down. But I wrote an article, I wrote a letter in the FT, and I responded to him, and I said, Mr. Axel, you are wrong, because you wrote your article in April, and I can prove to you that there were 2 episodes in January 2013 and February 2013 and in April 2013. These episodes, and if you all remember who have been dabbling in the market, that the biggest declines that we had in January 2013 and February 2013 and in April, we had some mini plunges in the stock market, and they all came in tandem with a decline in euro yen and dollar yen, i.e. a rise in the Japanese yen. So, and basically, so I said, yeah, as long as stocks are pushing higher, the yen continues to go down. But here is what you need to know. Whenever there is a decline or a shock to the stock market, the reflexive trade, the reflex is to go back to the Japanese yen. Yeah. Now, let's talk about the why for probably 30 seconds, and then I'll go back in demonstrating it in the charts, okay? Yeah. So let's talk about the whys, and then I will go on demonstrating this in the chart. The why to why the yen goes up and the stock market goes down, and vice versa, because since 96 or since 95, interest rates in Japan had been near zero. they have been 0.5, 0.6. So basically, if you are Japanese and you want to make money in a bank, you cannot make much money in the bank. And basically, you want to make money by putting your money, converting it to another nation's currency, and putting it and taking the yield out of that nation's currency.
Yeah.
And those of you who came across the Mrs. Watanabe concept, Mrs. Watanabe concept. Mrs. Watanabe is a concept that is given to the carry trade.
Yeah.
And basically what happened when the Japanese men were working in Japan, women were not usually working in Japan, so they had to make money. How did they make money? Well, a most typical job for Japanese housewives was to go and sell makeup and beauty products as the Avon lady,
Really?
okay, going door to door. But then that no longer was really working, so they decided to be approached by banks and insurance companies and go to these housewives and tell them, yes, you should continue to go from door to door, but don't sell makeup, sell financial products. Actually, sell this product, which is putting money, getting people to open an account with our banks, and they will put money in high interest or high yield instruments.
Wow,
Okay?
I never heard of that. Is that the real reason behind Mrs. Watanabe?
No. Actually, I am getting to it.
Yeah.
And many
It
women
could be
have
a reason for the collapse in the cosmetic market at the same time. Sorry.
yeah, maybe. Yeah. But all right, that's a carry trade. That's
Yeah.
an unmakeup carry trade. So basically, so no. So as far as 2001, as far as in 2002, many Japanese housewives were making money by opening accounts in currency trading and selling the yen and buying the Aussie. They said, I don't need to go to a bank and open an account in a foreign currency denominated account, which requires a minimum deposit of God knows how much. I can just open an online currency trading account. And when these companies allowed us to play on margin, on leverage, then everybody was buying Aussie yen, New Zealand yen, sterling yen, and these were the main ones. New Zealand yen and Aussie yen. These are, countries that are relatively close to Japan, relatively, and they basically know I will sell the yen, and this is what Miss Watanabe trade. It was called the carry trade. Well, I mean, you can Google all of this stuff and you can read it, but I'm just basically giving you the summary. So this was the carry trade. The carry trade. There are two examples of the carry trade. There's a carry trade in the bond market, which is basically between the short maturity, where basically you borrow short and you lend long. Sorry, you buy long and you sell short, and the maturities, or there is the carry trade in the currency market, which started with the yen basically being sold, okay, and putting money into not only higher yielding currencies and commodity currencies, but gold. And that's why in 2007, when okay, so so you look at this chart, June 2007. This is the S&P 500, but actually the chart above. This is just to make this okay. So this is euro yen. The blue one is euro yen.
Yeah.
The white one is Aussie yen, and the green one is sterling yen. And dollar yen is basically almost the same. So if you see this, basically the sunniest part of the world climate, of the world financial climate, okay, the sunniest or the best part was in 2005, 2006, and early 2007. This is when people in the United States were doing house flipping, okay? They were owning 2, 3 houses with virtually very little money down. People were making money in housing market from Iceland to Finland to Norway to Kathmandu. Okay, everything you touched was going up. And basically the yen was the worst currency, was the worst performer, and the dollar became actually also underperforming. So all of these currencies are going up against the Japanese yen. So basically, so that was the little history. But the flip side to that is what? Is when the stock market would go down, and when these currencies would go down, the money would go back to the Japanese yen. Okay? And now you may tell me could you tell me exactly how that works? we don't have much time to go into it, but it is a reflex that is triggered by hedge funds. Okay? It's the hedge funds that are really calling the shot. That basically they sense this trade, they play it, and they're the one that amplify the impulse part of the trade and the reverse part of the trade.
Yeah.
And that's how they do it. And then the hedge fund play it, and then when you are a reporter and you're trying to write the whys, to explain the whys, you speak to your sources, and then you write it down in the next day, and then people read it, and then the anchors on TV start to talk about it, and then people start to talk about it in websites, and then everybody starts to know how it works, and it becomes self-fulfilling dynamic.
Yeah. What do you think about the dynamic in the yen today? I mean, it's been trading sideways for a very long time now, and after possibly the clearest trend in the last few years.
Okay. Yeah. Okay. This is a tough one. So basically, let's just move the chart, Sver. So, to try to answer your question. Yeah, I still need to tackle the topic that you guys talked about, which is bonds and the dollar, and it's very important. I need to talk about it because there is another thing. I'll get to your question in a bit, Sver, but the very important one is the yield and the yen, meaning, the 10-year yield and the yen. And actually, if you want to sound cute, you can call it the Yellen yen yield trade.
Not if you've had too much to drink, you can't.
So, look, basically the Japanese yen, guys, it has been, it's been going up because the financial year in Japan is going to start in April. In April, that's when they're going to double the asset purchases of the Bank of Japan. And the head of the Bank of Japan, Kuroda, has been handpicked by the Prime Minister, and basically he is playing his game, and they need to weaken us all. The only problem, here's what you need to know, is that there is one issue, is that this sell yen, buy stock market idea, the reason that the yen is not going down as much as it has been going down in earlier months, i.e. the reason yen crosses, and when we say yen crosses, by the way, people should not get confused. When we say yen crosses, Aussie yen is a yen cross, Euro yen is a yen cross, dollar yen is a yen cross. So when yen crosses are going up, that means the yen is going down. When yen crosses are going down, the yen is going up. So now that we have gotten that out of the way, the reason that the yen is not going down that much, the reason that yen crosses are not going up that much is because there is something going on. And that something is that the idea that the Bank of Japan is going to put so much money into the system and so on and so forth is actually being slightly offset by the fact that Japan is going to raise its consumption tax. Okay? It's going to raise its consumption tax, and people are fearing that when the consumption tax will go up, the Nikkei may actually come down a little bit, and when it comes down, when the Nikkei comes down, there is that correlation again. The yen will start to go up. When the Nikkei comes down, then there is a blow or distress to that carry trade, and the money goes back to the
But
yen. Not
can
hold
you
on.
legitimately call it a carry trade? Not to.
It's an unwinding of the carry
Yeah,
trade, an
because-
unwinding of the carry trade. Yeah, please hold on.
Yeah.
Okay, people who have been trading in the market in the 90s are afraid that it's going to be shades of, I believe, 97. I think it was 96. Maybe Larry, maybe Ed will help me here. That's when Japan made a huge mistake in, I believe it was 97 or 96. I think it was 97, when they made a huge mistake and they saw very small shades of a recovery, and they decided to raise taxes. And when they raised taxes, boom, it killed off the economy, and it sent.
Yeah, it's funny. There are analogies. I mean, a really curious analogy, Ashraf, is you're talking about the same. As a point I've made before, talking about the same period after the '95 Kobe earthquake, as the recent was it 2011 earthquake. We've seen the yen weaken. You've seen aggressive monetary policy, and now you're seeing talk of taxation as well, consumer taxation. So the parallels are a bit uncanny. So, but yes, you're right. I think you're more of an expert as to the timing of taxation in Japan, but I think you're right. Yeah, and the analogies are strong.
Yeah, and so here's the thing. What I want to talk about, guys, which is very important, which is the yields, and this is basically for those of you who said, "Why do I care about yield? I don't know how to make money through yield. What are yields? What are bonds?" Basically, this is just before we start to explain the what in this. Let's just state the this relationship, and that's basically, and if there is any. Okay, so if anybody has the drum roll, they might as well use the drum roll. You can do the drum roll, Edmats. The remaining strong correlation in the market, if there is any remaining strong correlation in the global markets, you are looking at it right now in your screen. Okay? So let your eyes do the talking before our mouths start to do the talking. And your eyes are not fooling you. The red and the white is not the same. Okay? So I'm going to further expand this. So basically, the red is the US 10-year yield, the yield on the US government bond. Technically, it's called a note, a treasury note. It's the 10-year bond. Okay? And it's the yield, not the price, the yield. The price goes one direction and the yield goes the other. There is an inverse. Prices of bonds and yields of bonds are inversely correlated. There's an economic reason to that. There is a mathematical reason to that. You can look it up in the internet. But we deal with the yield. We don't need with the price. Now, the white is the dollar yen. Okay? The white is the dollar yen. Now, the reason that dollar yen is so highly correlated with the yield, it's not because of the US part, and that's what a lot of people get it wrong, but it's the yen part. So, what does that mean? If you see this, this is sterling yen, and this is euro yen. Okay? This is the euro. When the blue is going up, the euro is going up and the yen is going down. And the green is going up, the sterling is going up, and the yen is going down. Now, you can see that yen crosses and yields are highly correlated. Okay? Now, why is that? Haha. Well, the reason is for the same, it is the chase of yield. Okay? It's the chase of yield. The Japanese, when they're hungry for yield, okay? So basically what it is, when yields are going down, the Japanese, they take money out of Japan and they put it in euros, they put it in other currencies, okay? And that is at the same time, okay, when the yields are pushing higher. When the yields are very down, when the yields are very low, when bond yields are low, they take their money out and they put it back into Japan. And there is a reason why, because there is a reason why they don't want to put it in yields. And hold on, and this is what you need to know, is that some people are saying, wait a minute, you're only talking about US yield? No, sir, or no, ma'am. This chart, the red one, it applies to US yield, to German yield, to Canadian yield, and I'm going to demonstrate it in the next 2 seconds. Okay? Just to show you the next chart here, that US yields, they move in tandem with all bond yields around the world. And this is the chart right here. Okay? So, there you go. There you are.
Interesting.
There might be different levels. Sorry, yeah, go ahead.
No,
I
it's fine.
think you
I was
wanted
going
to
to
say
take
something.
draw on what you've just said. So finish your point, please.
Yeah, it's basically the red one here is the UK yield. UK bond yield or gilt yield are the highest in the industrial world. The white one is the US. The blue one is Canada. The green one is Germany. And the purple one is Switzerland. And this is Japan. But they all move in tandem. Sorry, yes. So Zver, you wanted to say something.
No, it's me. I was butting in. Well, actually, what's interesting, you've highlighted an important point there. That one thing we forget is we're talking about the percentage movements of these different markets, and how they will move in sync, or the percentage movements will be related, not necessarily the absolute levels. So the yen can appreciate being a carry trade. the yen can weaken, say, like 5% on the back of a 10% stock market move. They don't necessarily have to move to the same extent,
Absolutely.
which is
Absolutely.
one thing strikes me really clearly from what you've been saying today, Ashraf, and how we started the show talking about John Murphy, and it's excuse me, is that John Murphy started off talking about the relationships, and you were quite right. He was very bold. It's still a relatively young approach, if you like, very bold in some of how he described some of the relationships, but he described them in very economic terms, which again was ironic because he's a technician. But he talked about the causal links very much in fundamental terms. And that, you've been very articulate for 20-30 minutes going through a whole series of charts talking about how, particularly hedge funds, but how the flow of money, I call it the weight of money, but the same thing, the flows, will decide how these markets interrelate. And it's a big jump from the causal links that are traditionally being seen and probably to some extent are still seen to be causing these relationships to move and how they relate day by day with the perception of those relationships. And you talked about Mrs. Watanabe and more importantly, the hedge funds. And that, to me, I think is a real gem because it's the perception. I talked a bit about the correlations to how the perception of the causal link is important, not necessarily the causal link itself, but it's the perception of these links and therefore how the money moves that decides whether today that relationship between the dollar and the yield is good or whether tomorrow it's bad and whether the yen is in fashion or not. Comes down to the perception rather than the fundamental links themselves. Does that make sense?
Yeah, it makes sense. And actually, for those people who are listening to this right now and they have a technical inclination to the market, and when they start to pay attention, when they start to listen to the why part of this webinar, some of them will go and reach out for that coffee, or they will go and change the channel because they say, I don't need to know the whys because the rationale is usually related to fundamentals, and I've been programmed when I came to this earth to understand everything via technicals. So it is important to open your mind to everything, whether it's technical or fundamental or that religion or this religion.
That kind of goes back to what Ed's position is. Ed is, has got a number of different approaches. And I think that's an extremely good point you have there, because when you talk to traders, especially me who's not a trader, I like trading, I work with trading, but for me, trading is it's kind of an abstract thing inside a big part of the world. And you talk to these traders that only look at a single chart. They only maybe trade the DAX, for instance, and they only look at the chart, and they never. And sometimes it's very hard to talk to these people because they're never thinking about the why.
Well, there's a very good quote, Sverre, there, and I think you might have it, and we've used it before, from Dennis Gartman. About it's one of his many rules. Most of his rules I've discounted, or I personally discount, but he really sums it up well by saying to trade successfully, you should think like a fundamentalist, but trade like a technician.
And I agree with that. Yes, but here is the thing, guys. I mean, for me, before I get into a trade, I have to look at the technicals, and then I'll see what is the fundamental rationale. If I look at a fundamental trigger, I am not going to get into it and use it until there is a technical support. And that's very important. And a lot of people, they think because I wrote this book called Global Trading, Intermarket Analysis, they think that I'm totally fundamental. I just chose to explain some important parts in terms of the fundamental. But the trading is something different, which actually does not necessarily go out of line. It can actually gel with the technicals. And allow me to demonstrate the technical support to these things that I mentioned. So basically, I have two charts here. So I have the 10-year yield, and basically before I look at the chart, so I want to remove them. So I don't want to distract you, and I want you to listen to me and not look at anything. The reason that we talk about these intermarket dynamics is because it gives you an added confidence to trade. What do I mean by that? You wake up in the morning, you have your coffee, whether you wake up at 6 in the morning or 7 in the morning in London, you see where futures are doing. You see how the Hang Seng, you see how the Nikkei closed. If the Nikkei closed up, if it closed up and you look at the futures for the FTSE, okay, and it's pushing it higher, then you want to be able to see that usually the yen is to the low side, so yen crosses are pushing higher. And usually that could also mean that the dollar is a little bit to the downside, even though this relationship has changed a little bit. But this is the kind of thing. But more importantly, is that, do you remember 2 weeks ago or 3 weeks ago when stocks were going down, 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 down? Okay, and
Just a little, yeah.
just a little, and yields were going down. Everybody was looking for the bottom. Everybody was looking for the bottom. Where is the bottom going to happen? Is it going to be below the 55-day moving average? Is it the 100-day moving average? Is it 55-week moving average? Whichever. And actually, the seminar that Ed and I did in London in City Index, it was February 4th and 5th or 6th or whatever, and it was around the time when stocks were nearing the end of the sell-off. The reason we talk about these intermarket things is because if you're a technical analyst and you're not sure, if you're a technical trader, and if you're not sure whether the S&P or the FTSE has bottomed or has a doji, or the oscillator is oversold, then if you're not able to see clarity in that, then you can look at it in the other price that moves in tandem to that or moves in reverse to that. So if it moves in reverse, you look at whether it's overbought. If you look at, so here is an example. So enough talking. Let's try to demonstrate this, okay? All right. And actually, never mind only this, I'm going to take you to the cityindex.co.uk, where basically I put a lot of stuff every day, every other day. I put in pieces here, and I'm going to take you to a place here. Where are we? February 6th, all the posts, basically cityindex.co.uk. There is stuff by, just to give you an intro about this, basically there is stuff by, here are our analysts. There is me. There is James Chen, who does FX technicals. There's Josh Raymond. And there is our new addition, Rosemary Okoli, who actually talks about stocks and talks about shares, and usually UK shares. And she talks about Dixon's, and she talked about the Facebook, WhatsApp, and she talked about ITV. Basically, this is the only place, if you want to know what's going on in the market, fundamentally or technically, what's going on, you go to this website, no other website. Okay, so, yes, allow me, so...
Even your $2,000 a month Bloomberg terminal is not enough for you?
No, that's not enough. That's not enough. Because not everybody, no. It's for people who cannot afford that. You know, they can come here and they can get it for free. But anyway, so let's just go to this piece, which is very important, which I just want to show, guys. Again, I want to take you to a piece that I wrote a few weeks ago about the yields, about the S&P, which is very, very important, about the yen. Just give me a second here. Yeah. Okay, so basically in here, there was a trifecta that I mentioned in February 3rd. So unfortunately, yeah, we cannot expand this particular chart, but basically, just give me a minute here. Let me just look for it again. Newer posts. Just give me a second. Yeah, here. Yeah, unfortunately, we cannot expand this chart. Usually we can, but now
it's an excuse for people to go onto the City Index site and check it out.
But basically, a dollar yen. No, it's not an excuse. Dollar yen. This is a weekly chart, and if you speak the Japanese language of Japanese candlesticks, it does not take a correlation, a genius to figure out that there is a hammer candle in dollar yen. Okay. And similar hammer candle in 10-year yield. Okay, and this was in February 7th. So February 7th, the problem is, and this is what happened here. So February 7th. Now, anybody who believes in these candles will tell you that if this is the reversal, this means that the subsequent weeks have to go up. And there has been an attempt at them going up. So let me just show you something else. For those of you who want, you don't have to take my word for it. You just, they say, if they say a picture is worth 1,000 words, then imagine how many words or how many pictures is a chart worth. Okay? So I'm going to take you to the weekly chart. And this is something that was happening as we were doing this seminar with Ed and I. Even though there was a strike in London, people were coming, running, stealing Boris bikes, coming to the office, just try to attend.
They were
Stealing.
trying to get away from the Arsenal match, mate. Don't kid yourself.
So here is the thing, guys. If you don't, so basically, we wrote it in February 7th. We said there is a dollar yen weekly, there is a hammer candle, and there's a hammer candle. And if you go to Google and you say, what is a candle? What is a hammer candlestick? It's basically, if it's a bullish, it comes at the end of a declining and it's a sign of a reversal and it's the beginning of a rise. Okay? So we don't only talk about a mirror, you know, what's the word? Hindsight and, you know, and hindsight 2020. We talk, but we take you to a situation where we're looking forward and it worked. And yes, if you understand intermarket, you will know that the more conditions, the more dynamics are supported, the more you are comfortable in making a decision because this is your money that is at play. Okay? You're not showing off. You're not doing, this is your money that is at play. And you, in order for you to make a decision whether to buy or to sell, you need to have a high certainty principle. And the certainty principle comes in with if everything is gel, is everything gels. And this, the 10-year yield was reaching a candle, a hammer, and this, the stock market, the S&P, oh my God, the S&P, look, it fell. It went from 1850, and now it fell 1790, and now, but look, this is a weekly candle. So in English, a weekly candle ends on when? The last day of the week. What day of the week is that? It's a Friday. So if you look at it on Thursday and you see a candle, you say, oh, well, let's see how it's going to close the week. And lo and behold, this thing called the stock market, it respected this law and it went up to a new all-time high at a time when people were going on in blogs and were talking, they were saying, oh, we're going to see more declines. We're going to fall. We're going to,
and that,
okay?
Yeah, we've covered that a little bit in a few of the shows we've had. Ashraf, actually, there's one interesting point. I just again, you know, this is quite a few gems here. You talk about the end of the week. Do you find that with looking at the different markets in blocks as well, the intermarket relationships, do you find that looking at them at the end of the week or at the end of the month is a better way of getting the consistency? I know it's easy. It's always easy in retrospect, you know, looking at history to say how they were related and how they moved or didn't move in sync. But as you know, as you sit there live trying to work out the relationship and what influence it will have now, do you find looking at the end of a day or the end of a week or the end of a month or even quarter, do you find that more useful to get a better read of how the relationships are really hanging together?
Well, I've just shown you an example, Ed, that we don't only specialize in hindsight. Hindsight are for people who like to be feeling safe in their cocoon of the past and try to explain the past. And when they try to predict the future, they will start to talk if and but. Like many people, they sell services and you tell them, what do you think is going to go forward? And they say, well, if we're going to go above here, then this is going to happen. It's like, oh, I predict that tomorrow, if I will be hungry, I think I will be eating. You know, there are people who actually charge a service for things like that. Okay. So what we try to do is that this example that I showed you in this piece, okay, this was written on February 7th. February 7th, what day of the week was February 7th?
A Monday.
It was a Monday, was it?
No,
Okay.
it wasn't. It was a Friday.
Oh, it was
Sorry.
a Friday. Come on, it was a Friday.
I was just trying to throw you a wobbly, mate.
You know why I remember that? Because February 14th, which we know what February 14th was a Friday. So February 7th is also a Friday. You see, we also do Valentine's Day here in City Inde.
Yeah, well, I didn't get any flowers from anyone, so that's why I forgot. Sorry.
Well, it was very expensive for me. How can I forget that day? Anyway, so February 7th was a Friday. That is called by definition the end of the week. So basically, I did not have to work very hard. That candle came in, it was a weekly candle, it was a Friday. So when it comes like this, it tells you that this may be a reversal, which may start, which may basically start to push higher. Now, so looking forward, it's telling me what? It's telling me that dollar yen may be getting ready to push higher. That means that the yen is getting ready to further weaken, and the stock market is also getting ready to push higher. When I am expecting the next week where stocks are going to do what? Are going to improve, then I'm going to basically try to be either negative on the dollar or be more positive on the euro, and that's where you get to the nitty-gritty of stuff. If I am ready to sell the yen or to sell the dollar, I want to do it against what? Meaning I want to sell them against what? Against the euro, the pound, the Aussie, and that's where your analysis comes in. And that's where you say, which currency do I want to buy? Because it's all about selling the weakest and buying the strongest. You buy the strongest versus the weakest. You want to get the biggest bang out of your buck. Okay? Why do I want to buy the euro versus the dollar versus the yen when the Bank of England and the UK data has been better and better? Why do I want to buy euro yen or euro dollar when I can buy sterling yen or sterling dollar? So what do I do? What do I do? I take the euro versus the sterling chart. If I'm undecided what to buy, Aussie dollar or euro dollar, I look at the euro Aussie chart. Okay? This is how you do it. It's all about the strongest versus the weakest and so on and so forth.
Do you
And
find,
that's
I agree entirely, but one thing I factor in also is something I call volatility. So it's not just the volatility, it's not just what I think will be the strongest and the weakest, but also the clearest. Because, it is a question about managing risk. So if the market is something like the euro, it's going after every stop in Christendom that ever was. So, that's the nature of the market. And if I don't get it right, I could have the right view. I could be long of what is going to be the strongest and short of the weakest, but I'm stopped out of the position.
right.
So sometimes I personally, not everyone trades the same way, but I personally look for a clarity because it helps me manage my risk. Do you find that also is a factor?
Well, absolutely, yes, and that's where you get your knowledge of technical analysis. So here we've been long sterling. This is my own signal service. Ashrafladi.com. You go to premium, and basically we've been long sterling since actually July. And we've been long and long and long sterling. I actually went on CNBC in the first week of January, basically saying why sterling would go to 1.7, and everybody started looking at me as if I was speaking Chinese. There's nothing wrong with speaking Chinese, but for a guy who looks like me to speak Chinese is unusual. So basically, when I said that, okay, Louisa, this is Louisa Boyson of CNBC. Well, I'll tell you, Louisa, why I think sterling is going towards 1.7. And basically, for those people who saw that interview, we'll see we're not at 1.7, we are at 1.67, but I still think that we're going to push higher. So to answer your question, now what do you do? I'm just speaking about the beginning. Now what do you do? How do you increase your confidence that this chart has bottomed? And that's where you use other schools of technical analysis. Okay? Because technical analysis itself is a whole, like I said, it's a whole building. It's like a department store or a supermarket. There is an aisle for oscillators. There's an aisle for volume studies. There's an aisle for trend analysis. There's an aisle for moving averages. There's an aisle for price-driven techniques, i.e. candles and bars. And when you go to the supermarket, you don't only go to one aisle if you want to eat, okay? You go to various aisles, okay? To feed yourself, to clean the house, to do all of that stuff. And if you want to have a good comprehensive approach of technical analysis, you need to have a chart that this is not a webinar about technical analysis, but you cannot do one without the other. So what do you do?
I want to ask Ashraf and add a question here, because there's a lot of things happening in the world right now that's kind of confusing and hard to fathom, maybe. And something that just came on the wire as you were talking right now, I just want your reaction. Like, how do you look at this? Because we talked a lot about technical analysis, and then we we bring on some sort of fundamental analysis, and then you have all the things that are happening in Russia and the Ukraine. And just now on the wires, a few seconds ago, it was said that President Putin orders test of combat readiness of armed forces in western and central Russia. How do you guys as traders read something like that? Just completely in a different.
Okay, well, basically, you know, this is very interesting. Back in the days in the 90s of the Deutsche Mark, whenever there was something happening to Yeltsin, whenever he had his third or fourth, that is Boris Yeltsin, whenever there was a news that he had his third or fourth heart attack, okay, people would actually buy the Swiss franc and they will sell the Deutsche Mark, okay? The reflex right now is not the same. Right now, there's so many things going on in Ukraine that you may say, why is the euro not going down? Well, the euro may not going down, but actually the Swiss franc is doing very well, okay? So this is something that has not been talked about, but the Swiss franc is doing very well while this stuff is going on in the Ukraine.
Yeah.
But now, when you hear something like you just said about Putin, when you say something here about Putin, well, basically right now, it's not now that Putin has spoken that there is going to be an impact or a market impact of the geopolitical situation, because the geopolitical situation in the Ukraine has been getting worse for the last 3 months.
Yeah.
So, but if he says something that he's going to ready to deploy some of his arms, you know, in Russia that are overlooking, you know, towards the west and so on and so forth, then obviously probably then gold will have to push higher. Maybe the Swiss franc.
That was my. As soon as you said the question, my first thought is, you know, that you can argue both ways on the euro, and as to which way it will go, because it has that traditional Deutschmark relationship. But you also think, you know, the link to gold is the key one, because in fact the euro, strangely, you might see euro and gold move higher in tandem. My first thought is that gold would go through. You know, it's going to push up closer to 1380, which I think it will do anyway, not necessarily straight from here, but where I would sell it, which would suggest a normalization of things, no real big crisis, and see gold come back down into the range. So it's, for me, just as an aside, I'm looking to sell gold higher up. But.
Exactly. Where do you sell the gold? This is very tough. Before 1350, there is 1350. There is like moving average. But let me just go back towards using technicals here. And I'm glad that this Sver has disrupted this orderliness of the webinar and thrown a nice question from the real world, because that's how the real world works. You know, you're looking at this and then something happens, and so it's very good. So I'm glad that there has been that added to this chat. But you know, let's just go back to this, which is basically, okay, just before I go back to this, I just need to say something. In today's world, this is such a new, brave, desensitized world that it takes a lot and a lot to make a geopolitical impact, a geopolitical dynamic impact the markets, okay? What do I mean by that? Before September 11, 2001, anything that happened, you know, would have a field day in the global markets.
Yeah.
Whether it is Saddam's invasion of Kuwait in 1990, August 1990, just to be precise, August 2nd or August 1st, 1990. Or the many forays that Saddam used to do in Kuwait in 1996. And for those of you who don't know this, a very good way that Saddam used to make money, and people don't know this, but because you know what happened, right? After the Gulf War in 1991, you know, Saddam was not taken out. You know, they basically, you know, the Allies and the Arabs, they came out of Iraq. They went back to their countries. Saddam stayed. And how did Saddam make money in 95 and in 96 and then in 97 and 98? Do you know how he made money? Well, he made money by many ways. But one of the ways was to do what? He would buy oil futures, and then he would mobilize the army back towards Kuwait. People will know about it. They will read it in the news. Oil prices would go up, and he would sell. Si, senor. This is how he used to do it. And you don't get that. You only get it on big TV or small TV when Ashraf Lighty is on.
So are you saying that Putin's long several thousand gold futures here?
Why not? Why not?
That is a
not?
great call.
Anyway, the point that I was making is that
Well,
the point
the
that I was making
Abramovich
is
is
that
doing it
if
as well. That might be worth a few. Anyway, carry on.
so the point I was making is that nowadays, I mean, there is, when the U.S. or the globe or the allies or whatever you call them were on the verge of putting a strike on Syria a few months ago, what did the markets do? They did nothing, nada. Oil prices went up a little bit. When there was the Arab Spring and Egypt was boiling, and oil didn't really go up that much. So the geopolitical sensitivity, it's a brave. We are used to seeing ugly things on the internet, on YouTube, whether we are 12 years old or 22-year-old or 80 years old. We are becoming less sensitized. We are more desensitized, and so are the markets. Okay. Anyway, having said that, let me just. Yes, go ahead.
No. Carry on. If you've got a point to make, then make
Okay.
it,
Well,
please.
the important point, which is this is this is what the market is looking. So the S&P. I just want to go back to that point about this. Okay. So when the market was going down and people said, "Oh my God, we're finally going to see our 10% decline in the S&P," this is a weekly chart, but if you're going to add the moving averages, and the moving average that I use are the 55, the 100, and the 200, okay? If you look at the daily chart, ladies and gentlemen, okay, is that...
It's a very showing one, is it? I can't see the daily chart.
No.
Okay. Let me just expand this. Let me just expand
go.
this. Just expand this. All right. Okay. So this is the S&P 500, and the S&P did not even go down more than 7%. So the S&P topped here. It started to go down. This is a daily chart. We fell below the 55. We fell below the 100-day moving average, but we were nowhere near the 200-day moving average. So, and actually the decline from here to here was not even 7%. Okay? The decline in the Dow, if you allow me, huh? The Dow, guess what, ladies and gentlemen? The Dow did break below the 55, the 100, and the 200, and it stabilized around the 200. And here is what you need to know, is that, yes, so this is a daily chart. So here we had a close on the 3rd of February. We closed the day because the candle is full, so the close is below the 200. But February the 4th, we went back towards the 200. February the 5th, we closed below it, but the 6th, we closed above it. Now, I'm going to make something very sensitive, very, very, very subtle, so you need to pay attention. Open your third ear, your fourth ear, every ears that you have. Okay. This is very important. This is a daily chart, okay? This is a daily chart, and this is a 200-day moving average, because this is a daily chart, and it's a 200. If the chart was changed to a weekly chart, this becomes a 200 week moving average. So what you need to know is that even though this is a daily chart, what is important is that on a Friday, so on February the 7th, the price should be expected, or not be expected, should be required to close above. Okay, it should be required to close above the 200-day moving average at the last day of the week, meaning on a Friday. Okay, so that same requirement that you require for the weekly chart, meaning the weekly chart should close below or above the, on a Friday to call it a weekly chart. You want to know what the daily chart did relative to the day moving average on a Friday. So I don't know if I made that point here. Yes, go ahead, Ed.
I didn't actually say anything, but I was about to say something. My mouth opened, so well spotted. It looks like you're kind of defining some of your expected inter-market moves with moving averages, as in other words, using what is kind of a complex situation, trying to simplify it with technical analysis to give you a handle that you can trade it, which is, I think it's absolutely spot on, because it's a complex world, and sometimes it can be very confusing. And actually, you can either make it really complex and stay really complex and get it totally wrong, or you can simplify it and stand more chance of getting it right, which I think is kind of what you're alluding to there. There's Sverre, there's a great quote from Charlie Faulkner. Can you put it up for me?
Sure can.
About how people always need an explanation for. Do you want to read that out?
It might be a little hard to see. I can read it out here. Given the choice between a simple, easy to understand explanation that works and a difficult one that doesn't, people tend to pick the latter. People would rather have any story about a series of price changes happen than that there is no rational reason for it. Confusing hindsight with foresight and complexity with insight are a few more cognitive illusions of behavioral finance.
Yeah. Carry on, Ashraf. Yeah.
No, that's a very good point. You're right, and if I allow to expand on that, is that if you have a bias, if you have a losing trading position, you are doing further technical analysis you're usually trying to look for the analysis and you're looking for the scenario and the conclusion that supports your trade, as opposed to
we've actually did a whole thing on confirmation bias, which is quite true, and that's the difficulty when markets. The real world is complex, and markets are a reflection of that complexity. And you can either become a genius and understand everything, and still lose money, or you can try and simplify it to a point where you've got a handle over what's going on. You can control your risk, and you've got trades that stand a better chance of making money than losing it. There's a very good. We're coming towards the end of our time. I wanted to have to show you what you may or may not know. I'm a fan of Benoit Mandelbrot, guy who's talking about fathers and grandfathers of things. He was the grandfather or father of fractals. And there's a great interview with him and Nassim Taleb. If you can play that, because it is of the moment. I've wanted to cut out most of the 2008 doom and gloom background, because that doesn't seem very germane. But it does show you somehow you're talking about geopolitical events and how they may or may not have a huge impact or very little impact. And they kind of touch on it in this little clip. Sverre, can you show that?
We live in a world that is way too complicated for our traditional economic structure. It's not as resilient as it used to be. We don't have slack. It's over-optimized.
And I guess I'm realizing that that's where your famous work comes in. It's always been characterized, or the work that you're central to, as the butterfly somewhere disturbs a little bit of air, and halfway across the world a tornado hits or something, right? Is that what we're talking about here?
Something very similar. And the word turbulence is one which actually is common to physics and to social sciences, to economics. Everything which involves turbulence is enormously more complicated, not just a little bit more complicated. Not just 1 year more schooling. It's just enormously more complicated.
Turbulence is why, because it's badly understood, weather forecasters can't necessarily get it right.
Precisely. In fact, the basis of weather forecasting is looking from a satellite and seeing a storm coming, but not predicting that the storm will form. The behavior of economic phenomena is far more complicated than the behavior of liquids or gases.
So, getting back to your fundamental work and insight, this is a system that can become turbulent, or is inherently turbulent, that doesn't have enough of a buffer, and that's the danger?
That is not well understood. In fact, that is misunderstood, for which tools have been developed which assume that changes are always very small. If one of them comes, nothing bad happens. If several really thinks that things move slowly, gradually, and can be corrected as they change. Whereas in fact, they may change extremely brutally. Now you understand why I'm worried.
That's
That's
the
a
reason I
nice
want to share
end
that
there.
was because you got two guys there who believe in a very intellectual, a very good grasp, I think, of the complexity of the world, and yet they're saying that that complexity, they don't know. You know, it can exaggerate, it can have a little impact, it can have a massive impact. There's so much distortion and turbulence that some of these concepts we talked about today, that Ashraf being very articulate about, you know, the relationship between the yen and bond markets, etc. Sometimes they will hold true and it's really quite simple, and other times it's so complex, it's actually very difficult to even get your head around what might be happening. So that's why I was really interested in why, you know, you keep coming back to the point about the flow and people's perception of the relationships, not perhaps even more than the actual relationships as you know as they really are, and why at the end of the day it's finding the right technical approach, in my opinion, because that's my bias, but using some of these reasons why, but trying to frame it with technical analysis. And there's actually a very good quote from Ed Sekoite, if you want to put it up. It's very. That says basically, well, you know, fundamental analysis is useful and it can help you to understand how things work, but it doesn't often tell you by, you know, basically how much. And sometimes by the time you even know it, it's too late. And that's why someone like Ashraf, who's very good on intermarket relationships, has got a very strong background there, relies, I think, increasingly so, or you rely, but increasingly so on technical analysis to help frame it.
No, they are increasingly used. No, I would say I am with the actual trading, definitely technicals to locate my entry, to locate my exit. I try to use the technicals, or I don't try. I actually do use the technical to confirm any obvious development that comes in intermarket. If I do not see any obvious relationship or any obvious development, and I use the word obvious because you need to trade what you see. You need to trade what you see with the naked eye, okay? You need to trade what is obvious. If it's not, then you will have to do a lot of work, and sometimes doing a lot of work becomes trying to force something that is not. And that's how you lose money.
Can I throw you a wobbly? I haven't asked you this yesterday. I was going to do that. Frey, could you put the four markets back up? The chart, you know, it's my chart actually. That on the bottom left, Ashraf, you can see the CR. That's the CRB. The commodity markets have been these are 3-month clips.
Yeah.
Yeah, and you can see that a 10-year note stabilized. It's been in a downtrend, but stabilized, kind of linking a little bit with the dollar index. But it's the thing that strikes me most about that chart. You could say the S&P's actually gone nowhere. The CRB is very strong. Does that? What's that telling us? Is that telling us anything? Do you think?
You got the S&P. You said the S&P is going nowhere. I think the S&P is probably going places because.
I think so too. But I mean, from the point of view. Conversation I wanted to have was to highlight what the CRB is doing, what commodities are doing, and therefore, you know, is this a Mandelbrot point that in fact this could be showing the way forward in certain markets, or is it just an overshoot and it's not going to have any big impact at all? I mean, of those 4 markets, the most striking thing to me is the CRB index has rallied very strongly, and therefore does that have any implications elsewhere? And if we don't know, we don't know. Yeah.
Right. Okay. You're saying that the red one underneath is the CRB?
No, the bottom left.
Oh. That is the dollar. Okay. Yeah. Okay. So here is the CRB chart that you're looking at it. Okay, guys. I've just put on the CRB chart. So, all right, guys.
Yep.
So yeah. So the CRB chart, yes, it makes sense. It is up. It is at the highest level, you know, since February 2013. It's at a year high. Yeah. Oil is up. Gold is up. Copper is up. Everything you touch is up. Exactly. You know, what is this called? This is very interesting. Is it called the reflationary trade? What is this called? This is called that the market is now less
Spot on.
concerned. The market is less concerned with the tapering in the United States. It's taking the tapering in stride. It is expecting the tapering is not going to disrupt, especially when Yellen are saying that tapering is not tightening. Okay, that is one thing. And it just shows that, yes, that the carry trade is alive and well. And this which explains this next chart, which is not a lot of people are talking about. As a matter of fact, all the people that have called 2014 to be the year of the dollar are explaining in page 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 what of the Financial Times today. They are giving very eloquent, articulated excuses for why the dollar did not do what they expected. And these excuses are usually related to the weather. Okay, so basically, it's page 32, page 32 of the Financial Times. Incidentally, behind page 32, page 31, there is me. I have a very nice quote on the Chinese yuan, but but never mind that. Anyway, so let's go back. Let's go back and talk what I wanted to talk about. This thing called the euro, which a lot of people have been saying that it's going to go down towards 124, has been going up for 1, 2, 3, 4 consecutive weeks. Okay. Yes, you talked about the CRB, risk on, risk appetite. The euro, it takes it with open arms, and it is showing a very rare convergence in the stochastics, pushing higher, pushing higher, pushing higher.
Yeah.
This is a beautiful chart. I'll tell you why it's a beautiful chart. It's because not only it's showing 4 weekly gains, but when you look to the left of the chart, it is not even at the highs. The highs is 138.19. The high is a 138.93. The trade is only a 137.40. Okay, so this may give you probably a very cautious ability. It may give you an excuse to actually, or it may give you a reason to probably be long. I would say cautiously. Why? Because next Thursday there is the ECB meeting.
Yeah.
So we all know what happened in ECB meeting. Everybody could be expecting Draghi to come out and say we can pull the trigger of rates. But if people did not get the hint, because a lot of people, when they don't want to believe what is there, they like to look for other messages. Well, the ECB has already said it.
Yeah.
Disinflation, there is no disinflation. There is no deflation. Yes, inflation is slowing, but here is what people are failing to read between the lines. Actually, it's not between the lines. It's been loud and clear. Draghi has actually been touting the advantages of low inflation because it's a higher purchasing power. And he's been also attributing it to low energy prices. In simple English, when the central bank is saying something is actually not bad for purchasing power, and it is happening because of something, it does not really showing you that it is in a hurry to reverse it. Anyway, what is important, ladies and gentlemen, for the euro trade is Friday. Friday is Friday. It's the day after Thursday, which is the day after tomorrow. And that is when the CPI from the Eurozone, the flash CPI, is going to come up.
Yeah.
And if we're going to get, and that's where the technical people who only look at technical, they need to pay attention, or they need to be ready to things like that. It's the inflation numbers from the Eurozone. And if they show us another disappointment, or if there's no increase, or if we don't go above 0.7, then that may weigh on the euro, and we may see the euro coming back down. If we see a downside surprise, if we see an upside surprise, or if the inflation numbers, they stay the same, okay, then we're going to see the euro take off, and we can see 138.20 or 138.30 by the end of Friday.
Cautiously bullish.
Cautiously bullish, because here is the thing, Sver. Even if the number may be disappointing, people are going to be selling the euro ahead of next Thursday, and then Draghi comes up, and once again, as he did for the last 2 meetings, the meeting is on Thursday, next Thursday, 1:30 p.m. London time. Okay, and that's when the press conference comes in.
Yeah, I guess we're going to do that live, actually.
And if he does not hint at any rate cut like he did before, then like he did not do before, then we could see the euro retesting the highs, and we could see probably even the sterling going back towards going towards 168.
Yeah.
But last but not least, we are all here listening because we want to make dinero, money. So let me talk about my favorite trades right now, because we cannot end this webinar without putting my finger on what I think is a good trade. And this is something that Ed and I has spoken about. Usually, okay. So this is this is a trade, U.S. dollar. This is dollar CAD. It has gone a lot. It has gone a lot. But basically, I'm not going to spend time doing technical analysis, but basically 109, okay, 109.70, 109.10 is really the big support, and we are going to be retesting 112.50, 112.70, and then we go towards 113.
Yeah.
This is another one. This is another one.
But that will have to be the last one. It's Ed's about. He has to go, and we're having a show that's starting next, so it has to be the last.
This is the last one. This is
Yeah.
the last one, and this is the last one. This is a very nice one. You've got basically the weekly Aussie CAD. There is another one which is very good, but you have to be a premium subscriber to look at it. But this is that one is even better than this one. But this one, Aussie CAD, you've got the 10066 is a confluence of 100 and 200 week moving average, and the price is 99.64. So the price is 100 pips below that, and that's why we think this is going to continue to push higher. And last but not least, so basically, once again, if you want to look for just a market analysis, about IBM, about Twitter, about the dollar, about FX, you go here, cityindex.co.uk, market analysis, and we've got 4 able analysts who talk about anything under the sun. And as for the premium trades, you can go here, and you can go to home, and you can go to Ashraf Lairi, and then you can go to premium, and you can send me an email. Thank you very much,
Brilliant.
Zver. Thank you very much,
Thank
Big
you so
TV,
much.
and
That
thank you,
was
Ed.
so much good stuff from you. I know Ed wanted to talk about the Good Judgment project, but I'm not sure if we have time. Should
No,
we-
that's it. We'll do that another time. Someone
Yeah.
tweeted that to me. It's an interesting concept. Talking about City Index, so there's a colleague of Ashraf's, Josh, just sprung a story there that there's a rumor going around on Twitter that Moyes has been sacked. It wouldn't be the first time I've seen that rumor, but
What happened,
it's-
Josh? Did you put a? Are you doing rumors on Man United on Twitter? Okay. Yeah.
Well,
Because
United
guys,
is
if you know
trending
Josh,
in Norway on
Josh
Twitter.
Raymond
so-
is the biggest short, hedge fund short in Man United shares, and people don't know who Josh is. So let's give him some following. Josh is on Twitter, and his handle is what? Is Josh?
isn't it at I love
It's
Arsenal?
Josh
Really?
underscore. It's Josh at I love Arsenal. Oh yeah, it's Josh underscore Raymond at. It's Josh underscore City Index.
Well, it says here a guy named Adam Webb. He's got he's quite big. He's got 80,000 followers. He says Manchester United have confirmed to the New York Stock Exchange that David Moyes will leave the club by mutual consent an hour ago.
No. Are you
He's-
serious?
Moyes,
He's
Moyes
not a
confirmed
rumor
to the
monger.
New York Stock Exchange.
That's what
And
the
he's
guy
leaving?
says.
No.
Yeah, really. All right. Okay,
Well, that's
guys,
insider
this will
information.
not
I guess
take,
they have to say it if it's
Very circumcised.
chatter from the nicey. Yeah, it's 100 places.
This is
Yeah.
where I leave. This is my way out.
Yeah, I think this is our exit, everyone, and I want to thank everyone for tuning in. This is the longest one we've done yet, and Ashraf was absolutely great, and Ed was great as usual.
Thank you, Ed.
And we're going to continue on right away now with structured research. I'm going to get Michelle on. Thank you so much.
Take care, guys.
Ashraf,
Thanks.
thanks, and catch you later.